So my name is Cody Atkinson, and I work with IG Wealth Management in the Thunder Bay office. I'm a financial consultant and division manager, and we just help Canadians achieve their financial goals and dreams. Today we're going to talk about some of the ongoing economic issues, largely the trade war between Canada and the US, or rather maybe we could say the looming trade war, and how that could impact your financial plan and steps you can take to help mitigate the problems that this could cause you. Inflation is just the rising cost of goods and services over time, and it's largely impacted by an interest rate that a lot of people will be hearing about, the Bank of Canada overnight rate. And they will change that from time to time to try to control the economy and largely to control inflation. You know, they have a target of trying to keep inflation at 2%. That's pretty much their only directive, and they lower rates if it seems like the economy is not growing at an appropriate rate or if inflation's low, and then they raise rates to try to halt inflation and slow down maybe an overheated economy. Right now, we've actually had a rate cut last week, an interest rate cut brought to us by the Bank of Canada to try to fight against some of the looming tariffs and the tariffs that have already been announced, as a way of promoting economic growth, because the cost of the tariffs is going to be downloaded to the Canadian consumer in the long run, because it is just a tax on consumers in the long run. So a lot of people are concerned that the trade war is going to significantly impact the Canadian dollar and the right to do so. If money is not flowing into Canada via buying our exports, such as lumber, cars, car parts, whatever it may be, then there's less money circulating in our economy and less people buying Canadian dollars, because like all things in this world, the Canadian dollar is influenced by supply and demand. And if people aren't wanting to buy Canadian goods, which you need Canadian dollars to do so, then there's not going to be a demand for our dollar, and it will fall compared to other currencies. And that's true for every other country as well. So if European countries start importing more Canadian goods because of tariffs that hit them, then that could help strengthen our dollar against the euro, but it might not help us against the American dollar. If these tariffs all go away and the USMCA is actually treated fairly, then maybe our dollar will strengthen again. But for the foreseeable future, we're probably going to see a weaker loonie in Canada. An investment portfolio is made up of stocks, bonds, real estate. It's really anything that you can own with a future expectation of income. And that will look different for different people. Generally, there's a rule called the 60-40 rule, where you want to have 60% stocks and 40% bonds. That's not a rule that is set in stone, because sometimes you might be pursuing more growth via stocks, and sometimes you might need something more safe, and you would need more bonds, which generally they don't fluctuate as much as a stock would. The ongoing trade war, it's going to have differing impacts on people depending on if they're bond heavy or stock heavy in their portfolio, or even if they're real estate heavy. If the trade war goes on for a long period of time and costs are going up to consumers, then they're going to be able to spend less money on discretionary items. So maybe they're buying less vehicles, maybe they're updating their home less often. They're still going to have to buy groceries though. So there's a category called consumer staples. So stores like companies like grocery stores are going to still be in business. They're going to still sell produce. Yes, it's going to cost us more, but they're still going to run a profitable business. The sectors that might get hit the most are the automobile industry, especially in Canada and the States. There's significant tariffs being proposed, and because the supply chain between Canada and the States is so interlinked, the vehicles are highly at risk of having some large amounts of inflation hit them. There was one report saying like your standard level sedan could go up by $8,000 or $9,000 a year just because of the fact that components cross the border, especially in the Windsor and Detroit area, 7, 8, 9 times as it's being produced, and that tariff gets slapped on every single time it crosses the border. But if you build a diversified portfolio, not just the stocks, bonds, but also spreading around different areas of the world, so don't only invest in Canadian companies, don't only invest in American companies, invest in European, invest in Asian, African, South American, around the world, you can generally reduce the risk of these trade wars boiling over and devastating your investment portfolio. When it comes to a big purchase, we almost always recommend that if you can buy it sooner rather than later, buy it sooner. No one's ever projecting negative inflation. We saw something close to that in the Eurozone about a decade ago, but in general, things are always going to cost more in the future than they do today. That being said, if you're using debt to finance the purchase, then maybe you want to delay unless it's something that's absolutely necessary, like your water heater. But if you need to buy a new car, or at least a new used car, preferably sometimes, then buy it now rather than later, because we are expecting prices on all things to go up, not just in the trade war, but in general. Whether there's a trade war going on or not, we always want to make sure that you build up an emergency fund first. The general rule of thumb is 2 to 6 months of your expenses should be in something highly liquid, which just means you can access it quickly, and if that's $15,000 for you, it doesn't have the chance of becoming only $10,000 tomorrow. It's something liquid, it doesn't move up and down, it shouldn't really be linked to the markets at all, and that is your best protection against trade wars, other economic downturns, maybe investment downturns, and that's what you should do in the short term. And then I wouldn't say get more conservative with your investments. If anything, people should get more aggressive with their savings rates. If you can tighten the belt now and get that emergency fund filled up now, or the markets have already kind of tanked over the last couple weeks, if you can be investing now, it might be the good time. We never know when the bottom is, but we certainly expect the investments around the world to continue to grow over a 5 to 10 year window. And you'll be very hard pressed to look at the global stock market and find even a 5-year period where the markets don't go up, never mind a 10-year period. So for anyone working in a field that may be impacted, the pulp and paper, automotive, where you could be at serious risk of layoff in the next few months or years while this trade war continues, I highly recommend you take the time right now to address those high interest debts. If you have credit card debt, of course, get that paid off first. The easiest thing to look at is whatever your annual interest rate is, that's what you need to pay off first. And if you can't reasonably expect to beat that interest rate with an investment, and a balanced investment, nothing too risky, then you should pay that off before investing anything. That being said, you sometimes might have 2 debts that cost about the same interest rate, but one of them might be locked in, meaning that you don't get to use that credit as you pay it off. So if you pay off $100, well, you don't have access, you've just reduced your debt by $100. Whereas with a revolving line of credit, maybe it's the same interest rate as a locked-in loan that you maybe had as a student. You pay off $100, well, you're now able to access that $100 again. We recommend prioritizing paying off those unlocked loans so that it's your emergency account. Hopefully you've already got the fund, but if you need to, you do have access to revolving credit as well. No one knows when this trade war is going to end. It could be in 3 weeks after the April 2nd tariffs come into place, and all of a sudden a new agreement is made, because it's just such mercurial behavior that we're seeing from our southern neighbors. But it could also last months or several years. No one really knows. So without a crystal ball, you have to focus on your long-term plan, build a plan, stick to it, commit to it, and then start to protect yourself in the short term. So build that emergency fund. If you've got the emergency fund built up, you want to buy your disability insurance, your critical illness insurance to protect from things that you can control, whether you have protection from. If you have financial dependents, make sure that you've got an appropriate amount of life insurance. And sticking to your overall financial plan when the market goes down. If you end up selling long-term funds during these downturns, you can significantly hamper your ability to retire, pay for your children's education, or whatever it may be. So stick to your plan, build a plan, stick to your plan, and review it. You want to review it every year, and as these news stories are happening, make sure that your advisor is working with you, or you're working through your own portfolios to make sure you're on top of things. So no matter where you are at in life, the trade war might be impacting you, and even just overall financial concerns. What we would say to a retiree right now is, again, I know I'm going to beat the drum again, stay focused on your long-term plan, but make sure you're withdrawing from the right accounts. One issue that we'll see with retirees, whether that's be through an economic downturn or not, is they're withdrawing, trying to save their tax bill today and not paying attention to their lifetime tax bill. A lot of people might withdraw from TFSAs and their non-registered accounts instead of taking their RSPs early. And oftentimes, not all the times, that's why you have to work with your advisor and see what makes sense and run a long-term plan, take a long-term view. But oftentimes it actually makes sense to pay a little more tax now than you want to, because you'll actually reduce your lifetime tax bill. And your advisor's goal should be making sure you pay as little tax from now until the day you pass, not just today. When we're dealing with young professionals, an issue that we'll often run into is where they want to be a jack of all trades. And we have lawyers for a reason, we have accountants for a reason. I don't file my own business taxes, and I don't write my own will. We refer people to other professionals when they need them. But what young professionals or young families can do is, again, start early. The one thing that always blows my mind is the power of time. It's not so much how much you can save, especially early on. It's about building a habit. And if you start at 35 instead of age 20, you have to save 3 times the amount of money per month to have the exact same retirement. And that's only 15 years. If you don't start to your 40, 45, we're talking about 6, 7 times the amount of money that you have to save on a monthly basis. So I'd rather start at 20 and save, 50, 100, 200 bucks, whatever you can at the time, instead of having to all of a sudden wait 15 years, wait till you're established in your career, and then go, okay, now I need to save $1,000 a month out of the blue while you have a mortgage, children, whatever else it may be. Your kids are in sports, lots of other costs at that time. So get started early. Even if it's 25 bucks a month, it'll help. For those with kids, RESPs are always very attractive, and they are an amazing tool, but don't jump right into buying them with all you can, with all of your funds, because yes, you're going to get the grant, which is 20% of whatever you put into it, up to a limit each year. But if your own plan isn't taken care of first and you haven't protected yourself from some of the things that could happen to you, you might end up having to cash that in and then pay the grant back plus a penalty. So don't just jump at the shiny bauble, but plan to use the RESPs eventually, because they are an amazing tool, whether or not your child ends up going to school. So number one thing that younger people can do right now to help advance their finances is probably to stay off the daily news. Those that are managing their own investments will be influenced by what they see every single day. Now, if you're a skilled day trader and you've come up with a strategy, you've studied this, you hopefully are working at a bank or a financial institution, you might be using the news to stay up on things, but the average person who doesn't want to be making trades or shouldn't be making trades every day should stay off the news every day. At the very most, turn it off after one cycle, because it's not going to help you advance your overall financial plan. And there's just so much information that you're going to be bombarded with. We recommend people look every week, at most, every quarter for sure, so that you know what's going on your statements. But that's probably the number one thing you can do just to relieve some of your own stress. be better managing your money, because it's when you make these knee-jerk reactions to anything you see in the news that it can really hurt you. So hopefully if you do see something and you call your advisor, they're able to help manage that behavior and help make sure you don't make any knee-jerk reactions. And the next thing that they can do is talk to an advisor, and don't just walk to someone that you know. Like, hopefully you get referred to somebody, but don't just interview the one advisor. Interview 2, 3 advisors, different firms, see who's right for you, because if you're not going to listen to them, they're not going to be able to help you. So make sure that you like who you're working with, and that might take interviewing more than 1 or 2 people. This too shall pass is something that we say in the office all of the time. There's a great tool called the Big Picture that if you type that into Google, the Big Picture Investing, you'll see the stock market over time. Yes, there's downs, but as I mentioned earlier, if you take a 5 or a 10-year window, everything goes up in the long run, and it tags it with different headlines. You know, there's been some war or another around the world. Lately, it seems like every year there's a new war sprouting up. There's been oil crises, there's been recessions, there's been great bull markets, there's been bear markets. There's always a news story to scare you and give you a reason to sell. You won't see a reason to buy on the news very often. That's not exciting news. It doesn't sell newspapers, it doesn't sell minutes, it doesn't sell ads. So just, again, limit your exposure to daily news. If you still want to be knowledgeable of what's happening in the world, I highly encourage subscriptions to either weekly or monthly news articles or news publications, because they'll give you a long form update of what's been happening in the month, rather than here's 100 words, let's scare you into making an action and an impulse buy, sell, whatever it may be. Thanks for joining us today. I hope you've learned something, and just remember, this too shall pass. There's always news. Stick to your plan. First off, build the plan, stick to it.